Welcome back to Chapter 2, everyone. I hope you enjoyed Chapter 1 as much as I did. In this chapter, Abdul is going to be talking about candlesticks and their formations. So without further ado, I'll let Abdul take it from here.
So before we get into this, I'd like to quickly touch on what a pip is. A pip is a measurement in the forex market, and it means a point in percentage. Basically, it means that prices move 10 individual movements or 10 ticks in one direction. For example, you see 1.00000 to 1.00010 is a difference of 1 pip. So it's not the last digit, it's the one before that. If that changes by 1, then it's gone up by 1 pip. If that changes from 0 to 2, 2 pips. 0 to 3, 3 pips, and so on like that. If this is the one that changes, as we see here, the third digit in, the third number after the decimal point, it's in tens at this point. It's in 10 pips. So if this was from 1.00100, it's 10 pips from 1.00000. And if this was 1.00123, it's 12.3 pips. If that was 1.00123, it's 123.4 pips. So let me show you something. Let me just alter that for you so you can see. And we're now looking at 123.4 pips. So that's how price moves in pips, and that would be how you'd explain it and how you'd look at it. So 50 pips, 100 pips, they're just metric numbers used to measure this effectively. As you can see here, again, we have a difference of 0.0001 between the two numbers, and that is just 1 pip. If it was 0.0001, it'd be 0.1 pip. If it was 0.001, it'd be 10 pips, and on from there. So let's get into this video. In this video, we'll be going over different candlesticks. We'll be going over what they mean. We'll break down the candlestick. We'll look at their formations. We'll utilize them when trading, and we just aim to learn price action today, as well as having a cheat sheet at the end if you can't remember what's taught in the candlestick section. This is going to be quite a big, long video, so please do bear with me. So what's a candlestick? Well, to begin, a candlestick is simply the most preferred type of chart in trading. And why? Because it tells the whole story of the time frame in question. It will tell you the highest points, the lowest points, the opening price, the closing price, and in between, it's just called a wick. So here you have an anatomy of a candlestick. You can see this is a bullish candlestick, which we'll get into in the next slide. And it basically just means that price opens and closes higher than the open. So it opens down here, as you can see, and then closes up here. So it's bullish, it's gone up. So here we have a nice little candlestick that we're just going to dissect really quickly. So here you have the open, you see price pushed down here, and this was the absolute lowest point on this candlestick in this time frame in question. It did not go below that, but it did push back up and possibly up here. That's the highest point in this candlestick. It did not go any higher than this point, and it closed here. So that is what happened with this candlestick in question. You can see here the close is higher than the open. That's because it's bullish, and the body is the difference between the close and the open prices. That's the body of the candle, and in between the open and the low, and the closing low and open and high and closing high, that's just called the wick. That's the difference between the body and the highest or lowest point on the candle, as you can see here. So this is a bearish candle, as it's red. You can see it opens above where it closes. As you can see here, again, there's still a wick, and the body there. So on to the next slide. So, bulls versus bears. Like I mentioned, we were going to go over this in a second. And bulls just aim to see the market rise in price. Bears aim to see a fall in price. Red candles typically mean bearishness, and green candles typically mean bullishness. It really is that simple. Like I said, with the bullish candle, the open is lower than the close as price comes up, and the bearish candle, the close is lower than the open as price goes down over the time frame in question. As once again, we have this little candlestick diagram that we can look at to understand that. If you don't get it, feel free to take a picture of this and just analyze it yourself and basically just learn what it means, because it is really simple and it's really important to have this in your trading. So what types of candlestick formations actually are there? Well, there are single candle patterns, 2 candle patterns or double candle patterns, and 3 candle patterns or triple candle patterns. And they can all be neutral, bullish, or bearish. Like we said, bullish means going up, bearish means going down, neutral would just mean going sideways. So, let's get into the candlestick patterns that we'll cover in this video. So in this one, we'll go over hammers, inverted hammers. We'll go over the types of doji candles. We'll go over bullish and bearish engulfing, tweezer bottoms and tweezer tops. And we'll go over the morning and evening star candle formations as well. So, the hammer, what is it? The hammer just means that there's bullishness coming into the market. It means that the bears are weakening at this point, and usually it's followed by a collection of bullish candles. This is an example from the 15-minute time frame on GBP/USD, and I'll show you what happened after this in a second. But let's just get into the anatomy of a hammer candle. So here you have the opening price here. As it's green, you know price went up, so this is the open. You can see price actually came all the way down first, which means it pushed down. It made a big bearish move initially and then came all the way back up. So that means that the bulls actually took full control of this candle in the end. You can see the bears were trying to make it go down, 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 but they just ran out of steam and the bulls took it all the way back up here and it closed here. So what happened next with this? Here. So this is the candlestick formation I showed you just a second ago. And look what happened. Price just pulled back for an opportunity to enter, but it never really came back to this lowest point again. And then pushed up, moved sideways for entry, and pushed up again. So that's the power of knowing your candlesticks. And this is just proof of what they can do if you know them. So, the inverted hammer and the shooting star. So let's go over the inverted hammer first. It basically just shows bulls coming into the market, but they're not as strong as in a normal hammer. It's often found at the lowest point of a downtrend because that's where you get a reversal from. And it has to be a bullish close, otherwise it becomes a shooting star, which is a bearish candle. So here you have your downtrend here, and then right at the end of it, you have your inverted hammer, and then the price starts to move up from there. So, what does that mean? Well, I'll show you what that means because I have an example here. This is your candle in question, this one here. You can see it closed bullish, it closed green, and it's at the end of a downtrend. So, let's quickly touch on a shooting star before we get into that. A shooting star is just the opposite of this. It's an almost identical candle, except it closes bearish, and it's found at the end of an uptrend. So, the price is coming up, you get to the top, and you have your shooting star here. So what does it show? It shows that the bulls were initially in control. They pushed price all the way up to here, and then it came all the way down and closed down here with the bears. So that means that the bears took full control before this candle closed. And this one just shows that the bulls took some control. They were strong enough to make the candle close bullish, but not strong enough to take it higher. So what happened next? Here is the candle formation in question here, this one right there. And you see price never came back to that same level. It just went up, up, up. So that's once again the power of knowing your candlestick formations. So on to dojis. So what are dojis? Well, there are three types of doji candles. There are gravestone dojis, dragonfly dojis, and long-legged or star dojis. So basically, a doji candle is a candle with almost no body. It basically is just a straight line and a straight line. So here you have a gravestone doji, here you have a long-legged doji or a star doji, and here you have a dragonfly doji. So with gravestone dojis, as we've got here, you know that they're bearish. That's because they start low, they push high, so they show price was initially bullish, but the bears took over. But unlike a shooting star, they couldn't close lower. So you see, opens here, pushes up like in a shooting star, but comes all the way back down to where it opened, unlike a shooting star, which closes bearish. So this basically closes neutral. So it suggests that there is a big rejection to the upside, and there's something stopping price from going up, like a ceiling, so price is likely to come down following that, if you understand that. Here's a long-legged doji. It's indecisive or neutral. They show a struggle between the bulls and bears that eventually ended as a stalemate, and they show price slowing down in a strong bullish or bearish run. So you have your opening price here. Price has maybe moved upwards to this level, looking bullish, and then come all the way back down to this level, looking really, really bearish, and then come straight back up to close here. So it basically means the market doesn't know which direction to go, which can actually be good if it's at the end of a strong run. So, for example, there's been a big downwards move in the market, and then you start getting dojis next to each other. It means that the downwards movement has basically come to an end, and you can start looking for a potential reversal at that level. And the last type of doji is the dragonfly doji, which is just the opposite of a gravestone doji. It shows price opening here, pushing all the way down, showing huge bearishness, and then coming all the way back up to close where it opened. So it's just suggesting that there's a big rejection to the downside, like a floor. It's hit a floor, and what happens if you throw a ball at a floor? It bounces back up. So that's effectively what this is just showing here. It's showing that price has gone down and bounced back up to where it opened. So let me show you these in action. So here you have a star doji here, right there, at the end of a bearish run, like I said. And you see the star doji is the first signal to buy. It is at the lowest point in this move, and you can see price pushes up 50 pips and actually ends up pushing up higher, which I'll show you in a second, because you have a star doji and then you have two dragonfly dojis here and here. So you can see them all coming together and price going up from there. See, that was all found on the exact same example, and that's showing what price action can actually do if you look at it closely and understand. Two dragonfly dojis suggesting bullishness now, suggesting it's at the end of the bearish run, and yeah, price just moves up from there, and up, and up, and up. So, on to the next candle formation. We have the bullish and bearish engulfing. So I'm going to take this one at a time. So bullish engulfing, this one here, basically means that the previous candle was bearish, it's come down, and the next candle is bullish, but what's so special about this bullish candle is it closes higher than the bearish candle opened. It closes higher than the wick of the bearish candle as well. So what it is it shows that this bullish candle cancels out this bearish candle completely, because it's opened here and basically swallowed up the whole bearish candle, and it's made this candle seem obsolete effectively. No matter how strong this candle is, this one is even stronger. And that's what it's showing. So you see, opens at or lower than the previous candle's close here. The length of the bullish candle engulfs the previous red candle. See, takes up all the red candle, and then the bullish candle closes above the previous candle's open, as you can see here. You have this close well above where this one opened. So, onto a bearish engulfing, which is the bearish equivalent. It's just the same as this, just flipped around. So you have a strong bullish candle here. Yeah, you have a nice move to the upside, and then you see the bearish candle closes below or level to the previous candle's open. In this case, it gaps, and it moves up and engulfs the whole of the bullish candle. So it makes this candle obsolete, and it closes above the previous candle level. So you see this candle swallows up this candle and makes it seem completely obsolete, and whatever happened in this candle has been cancelled out by this one. Okay, so let me show you some examples of these. So here you have a really, really strong bullish engulfing candle. You have a little pullback on this bullish run, and then you have a strong bearish candle, which looks like maybe we could be looking at a reversal as well. And then you just get this huge bullish engulfing candle which swallows up everything this bearish candle had, even the wick, and then price just moves up from there and 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 keeps going up. And that's the power of a bullish engulfing candle. In terms of single candle patterns, this is probably, or double candle patterns, sorry, this is probably the strongest one. Here's another example. You have a strong bullish move to the upside here. You're looking like you could be going even further up. You have a nice bullish candle here, and then you just get this huge bearish engulfing candle here, which is double the size of that bullish candle there. Almost even engulfs this candle as well, which is quite strong for a bearish candle. You see price moves down, pulls back, and then pushes down and down. And just as we touched on in the dojis, here you can see a nice little gravestone doji in the middle of these two bullish and bearish candles. So just showing how price action comes to work together all over again. So tweezer bottoms and tweezer tops. Like with bearish and bullish engulfing, we're going to take these one at a time. So this is where there are two similar length wicks to the downside in terms of tweezer bottoms in consecutive candles, and they're often found at the bottom of a downtrend, and they signal a reversal. The bearish equivalent is the tweezer tops, where the two similar wicks are on the upside, and I have some examples to go with that. So this is what a typical tweezer bottom will look like. You have your move to the downside, you have your first bearish candle which wicks down but closes up there, and then you have another one which opens here, pushes down, gets the same rejection that you got in the first candle, and then pushes up again, and then you start to see an upwards move from there. So this is an example of a tweezer bottom, and I'll show you that in a second. And this is just a tweezer top. It's basically this just reversed, so you have an upwards move. You get an upwards move, you have a big wick to the upside, rejected, comes back down, closes here. And then from here, you have a move upwards, the same rejection as the previous candle, and it closes there, and it starts to move downwards from there. So it's like price is hitting the ceiling in this one, and it's hit the ceiling twice and then gone down, and price is hitting the floor of this one. It's hit the floor twice and then moved up. So that's effectively what it's showing. So let me show you two examples, one of each. And here you have your tweezer bottoms identified by this zone here. Down, down, same level they've been rejected at, and price just moves up from there and up from there and up from there and up from there, and doesn't actually come back to that same level again. And yeah, so that's just showing what's happening with a tweezer bottom candle formation. You just get two nice rejections to the downside, and then price just seems to gain a lot of bullishness from this. So you see this is a nice strong bullish candle, followed by 2, 3, 4 bullish candles, a little pullback, more bullish candles, and you see what actually starts to happen is the size of the bullish candles increase and the size of the bearish candles decrease. So the bullish candles are actually bigger than the bearish candles, and that's usually a really good indicator of which direction the market's going. Like even here, you have a nice bullish candle. The bearish candle is maybe 2/3 of that only. You have a load of bearish candles which are undone by 2 bullish candles, and it creates an even higher level there. You have 3 bearish candles which don't even engulf this one bullish candle, and then you have 1 bullish candle which undoes them all, followed by a collection, and price just seems to go up from there. And that's really what tweezer bottoms and tweezer tops can be the beginning of demonstrating. They'll show you the start of this before it happens. And here's just an example of tweezer tops. You have a nice move to the side, push up, first rejection at that level, second rejection at that level, and then price just starts to move down from there, and down from there, and down from there, and yeah, basically just pushes down maybe 200 pips from that level, from here to here. And that's just what it shows. It shows rejection to one side and the market changing direction because of this. And more often than not, you can see there's at this almost identical level, you get a rejection wick here, you get a rejection wick here, you get a few here. So it's usually at a similar level to where you've had rejection before that you get the tweezer tops. And here's even another example of a big rejection at that level. So on to the next one. This is our 3 candle formation, the morning and evening star. I'll go over the morning star first and then touch on the evening star. So it's a 3 candle formation which shows the end of a bearish run. They're often followed by a pullback opportunity, and they're always at the end of the bearish trend. And of course, the bearish equivalent is an evening star. So what about morning stars? So this is what a morning star looks like. It starts off bearish because the market's moving down. So you have your bearish candle, and then you get a doji candle here, a nice little star doji usually, or sometimes you can get a long-legged doji, and then you come and get a bullish engulfing candle effectively. So that's the thing with morning stars and evening stars. They're just 2 different candlesticks on top of this one that show a reversal. Like we said, a doji at the end of a bearish run can show that price is about to start moving upwards, and this is what this shows. So you have your bearish run, you have your doji showing indecision, and then you get your bullish engulfing which overtakes the whole of the doji, and then you get price starts to move up from there. Like here, we'll show you what happens with this one and an example of an evening star in a second. And here is again almost identical, just flipped around. You have your bullish movement, you have your doji, and then you have your bearish engulfing candle. And then you see price start to move down from there. And that's why these are so strong, because they're a mixture of a number of candlestick patterns all coming together to show a change of direction. So let's get to those examples. So here you see your move downwards from here to here. It's about 40 pips, 50 pips. And then you get your bearish candle, you get your doji type candle, and then you get your bullish engulfing candle. Like we said, It engulfs the whole of the body of the previous candle, sometimes the wick, but not always. And if you look closer, you can actually see that this bullish engulfing candle actually closes higher than the open of the original bearish candle. And then you see price just starts to move up and up and up. And it goes so far up that you can't even see where it ends. So that's a nice example of a morning star candle formation. So onto the evening star candle formation. At the start here, just so I couldn't actually show you how far this move actually took the candle formation, but here you have your first bullish candle here. You have a nice move to the upside. Then you get your doji candle here, your doji type candle, and then you get your bearish engulfing, and you see price starts to move down. You get a little pullback, like I said. You can often look for a pullback before you get your big move down, and that's exactly what you get here. You get your pullback, and then price never comes back to that level of the pullback again, and it just dumps, and it goes so far that I can't even show you how far down it went. So let's look at reversal patterns now. What are they? They're just, like they say, patterns that show that price is about to reverse. So if price is going up, these patterns will suggest that price is about to stop going up and start going down. And if price is going down, they suggest price is going to stop going down and start going up. So there are two main ones, the head and shoulder patterns and the double and triple top or bottom. So you can have the head and shoulders, the inverse head and shoulders, which is just this but flipped around, the double triple bottom, or the double triple top, which is just this flipped about around. So head and shoulders pattern, what does that look like? Well, like this. You have your left shoulder comes back to your neckline, like with your body. If your shoulder's above your neck, it'll come back to the bottom of your neck, push up to make a head, back to the neck, and make a right shoulder at a similar level to the left shoulder. So that's point 1, point 2, and point 3. Like I said, price will create a high, point 1, pull back to the neckline here, create an even higher high, point 2, pull back to the neckline, point 3 here, point 2 here, and then pull up to make point 3, which is the right shoulder, which is a similar level to the left shoulder. And at this point, before you enter, you look for candlestick patterns that we talked about already. So maybe look for a gravestone doji, maybe look for an evening star, look for tweezer tops at this level. That's what you're looking for to confirm your entry. And if you get that, you enter on the right shoulder, and then you see price come down and down and down. And an inverse head and shoulders pattern would just be this, but upside down. So you have your left shoulder, your neckline. So that's point 1 to neckline, point 2, your head to neckline, and then point 3 here. And then price will push from there. So I'll show you what happened after these little situations here, and I'll show you how far they went before eventually the move stopped. But yeah, this is just what it shows. You show your left shoulder here, neckline, head, neckline, right shoulder, push. And you're looking for your confirmation on this shoulder before you take your trade and look to push higher. And you're looking for the confirmation at the top, this one, before you take your trade to push slower. So, in terms of your normal head and shoulders, you have your left shoulder, neckline, head, neckline, right shoulder, neckline. They don't have to be perfectly symmetrical. They just have to have the credentials, which is point 1, left shoulder, higher level at the head after creating the neckline, price coming back to the similar neckline, and then coming back to show resistance at that right shoulder, and then you go down. So here, this shows how good this one was to trade off. I think it's a little helped by the fact that there would have been a little trend line there, but we'll get into that in chapter 3. But yeah, you get your nice little left shoulder, head, right shoulder, neckline stays constant here, and then on the right shoulder you get your signs to take the trade, and you fall down, 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 and make a nice little move to the downside to make quite a few pips on that one. And in terms of the inverse head and shoulders, this is your left shoulder, like I showed you, your neckline here, your head, neckline here. As you can see, there's a tool for drawing this on TradingView as well, but you have to be aware of what you're looking for, to be honest with you. And your right shoulder, you get a nice little double bottom, which we'll go into in a second, which is actually the next chart pattern that we'll look at, the double bottom. So that's your drive to downside, push up, drive to downside again, and then you see price go bang, move upwards. Similar level to the first shoulder, and then you see price move. And that's just how you need to be aware to look at these things. The neckline stays constant, and the left shoulder and right shoulder stay constant as well. And the head has to be beyond the shoulders. That's all that it takes to spot a head and shoulders and inverse head and shoulders candlestick formation. So double bottom and double top. We'll go over the double bottom here and the double top in the next slide. So with your double bottom, you have your move to the downside here. You get your first rejection, push upwards here to here, and you get another rejection to the downside. So you get another push to the downside, which gets absolutely rejected. You see here, it's a similar level or just beyond, and then the price starts to come up from there. So here you have your initial drive to the downside, like I said here. You get tweezer bottoms here, showing nice resistance there. You get your pullback and second drive to the downside, which gets rejected at the support level, which is here, a level that price just seems to turn at. And we'll go over that more in chapter 3. And you get a push upwards, and you get your morning star candle formation with your bearish candle, your doji, and your bullish engulfing candle, which is quite a strong one. And then you get your pullback opportunity here if you didn't enter off there, and price just moves up from there. And that's how a double bottom works effectively. It's quite nice, it's quite clean. It doesn't always have to be perfectly the same length, but as long as there's resistance being shown at the same levels, then you can see that price is going to start moving upwards very soon. And in terms of a double top, you see price pushing up from here, getting rejected at this level, pushing down, coming back up here, getting rejected again, and then price just comes down from there and moves down and down and down. And that's another nice candlestick formation. That's another nice example of a double top. Here you get an evening star on the first candlestick rejection. You get the first push up, you get that, you get your bullish candle, you're rejected, you get your doji type candle here, and then your bearish engulfing. However, it's not a bearish engulfing because this is actually a bearish candle itself, but it does still make an evening star, and you get your nice move downwards. Then you get another one, another drive to the upside, rejected, big rejection there, and you see price from there just dumps and goes down, down, and down. And that's how you trade at the double top and double bottom. You just look for price to be rejected at the same level twice, and you look for nice signs of rejections on the lower time frames, and you'll see everything you need to take a trade at this level. And if not, as you see here, a pullback opportunity happens as the candle opens there, but actually pushes up in this case, in this candle, like we talked about earlier. And you can enter anywhere here, and then price moves down and never comes back to that level again. So let's look at more advanced chart patterns. So here you have a triangle formation, and a triangle formation is really nice because you see price condensed into a small amount of space, which is ever reducing, getting tighter and tighter and tighter. And basically that's because price is just preparing for a bigger move. And as you can see here, price can't stay between these two closing levels forever, can it? And here you have the 3 examples. You have ascending, you get descending triangle, and you get the symmetrical triangle. Often, especially with the symmetrical one, you can see a fake out, which is just a false move before seeing the actual drive to the upside or downside, whichever way it chooses to go. So with an ascending triangle, it will come from below. It will have one horizontal rejection level that keeps happening and an upwards trend line, and you'll see price going down, up, down, up, down, up, down, up, and stuck in between these levels, which are getting tighter and tighter and tighter, and then you'll see your move and you get your big push to the upside. And in the descending triangle, it's the same thing, but upside down. So the price will be coming down already. It will get stuck in between a bearish trend line and a support level below, and price will be condensing, getting tighter, 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 before eventually breaking and going lower, always. So here are a few examples of your symmetrical triangle, ascending triangle, and descending triangle. So here you have a symmetrical one. You see price is coming from underneath, so it's moving up, but it doesn't always have to continue upwards if it's a symmetrical triangle. So you see price coming up, there, bang, there, bang, 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 bang. And then you get your fake out, like I mentioned. And often the fake out is in the opposite direction to the real move, but not always, so keep that in mind. So you have your fake out here, you get rejection candles on all of these ones. And then you get your doji, and you get your bearish engulfing, moving down, and then it breaks below. And you get your evening star candle formation right here with your bullish candle, your doji type candle, and your bearish engulfing candle, and then you just see price dump lower and lower and lower from there. And that's how you look at the symmetrical triangle. The fake out happens quite a lot with a symmetrical triangle, so always look out for that and be aware of that, and just keep that in mind when trading. In terms of the ascending triangle, you have your level here, you have your nice little resistance level here, which price is currently constantly rejecting off of here, 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 and then here. And then you see what happens, price actually comes back, retests this level here before pushing upwards. And like I mentioned, you get your fake out, which is in the wrong direction, and you see price start to go up from there. And that's what happens here. You see you have your condensing zone here, you get your fake out, nothing there to fool us, because nothing there suggesting that it's going to actually go lower. And then you have your push back into the triangle, holding again, breaks out, retests it. That's the really important thing. It retests it, and then price just goes up and up and up from there. And here's an example of a descending triangle. You have your horizontal support level here. You have price bouncing off of it, almost there, 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 there. And your descending trend line, price has come off it there, there, almost there, 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 and there. And what you see here is you get your fake out here, and this is actually a really interesting fake out because you actually get your retest and your move lower, but it can't be sustained. So that does give us a little indication to the fact that the fake out is in the right direction. Not many people notice that, but it's a little tip that I've given you here that works with ascending and descending ones. And that's because price is just trying to fool you into taking the trade a little earlier here. What happens is it comes back up, gets stuck between these zones again, and then moves down. And this, you have a nice little rejection candle wick there, here, and that's what you're looking for. That's in one candle, you get your break and your rejection, and then you see price move lower from there. So how do you draw one of these? Well, I'm just going to show you. I made a little example earlier, and I'm just going to share that with you now. So let's get into this video nice and quick. So what I'm showing here is price is coming up first. So you see price below is coming up, and you see this horizontal line there. You see that it's holding nicely. It's held nicely 1, 2, 3 times, and you can see that's what's happening here. Price is holding, and you just see this downwards trend line here, just creating a little wedge as a condensing space. And then what you see is price breaks beyond that and actually pushes up from there. So you see price actually breaks beyond that, as I'm about to highlight there, and then it comes back and retests that level, and then from there price just goes up and up and up. So that's what that's showing you. It's showing you the horizontal line that's supporting. You see the trend line, the downwards trend line in an uptrend, and it's all pushed up eventually to make a nice bullish move after that. So onto bull and bear flags. So these are flag patterns, and they occur during a strong bull or bear run, just like the triangles. And you see what happens is with a bear flag, price is coming down. The flag kind of pushes it up a little bit, so it's like a pullback. It's effectively price pulling back in preparation of a bigger push, and then you see price will eventually be bearish by the end of it, and that's how a bear flag works. And a bull flag, price is initially bullish, moves down a little bit through the flag, and then pushes up to make a bullish push. And that's how they're traded. So just like triangle formations, they're just preparing for a bigger move. And in this case, price is actually trapped between two parallel zones. So they will never actually meet or condense. So price isn't actually getting tighter, but price is preparing for the bigger move. So here are some examples that I have. So you see, you have a nice bullish move here, and then you get price trapped between these two levels here, which are parallel. So you get the top there, touch there, touch there. The bottom there, rejects, rejects, rejects. Then you have the top here, rejected off there. Bottom there, rejects, rejects. Top there, rejects. Bottom there, rejects, rejects. Bullish engulfing. So that's your first sign that it's about to break out here. You have a huge bullish engulfing candle. You have your breakout candle, which once again is a strong bullish one. And then you have a little pullback here to here. And then you have your opportunity to go long from there to buy that. So that's how you trade that. Price is moving up, moves down during the flag, trapped between these two parallel zones, and then pushes up higher, higher, and that's how you trade the bull flag. And in terms of the bear flag, you see price moving down, trapped between this zone, so rejects there, rejects there, rejects there, rejects there, rejects there, rejects there, almost comes up there, rejects there, rejects there, rejects there, and just like in the bull flag, you get a huge bearish engulfing candle which swallows up this strong bullish candle here. You get a big bearish engulfing, and price just basically doesn't come back to that level again. Comes down, breaks, you get your retest, and then price moves lower and lower and lower and lower. And that's how you'd look at the bull and bear flags here. So once again, price coming down, a pullback, effectively this big move is one pullback, and then a big push to the downside and making lower lows from there on. So how do you identify them? How do you draw them? I'm going to show you that again in a second. But what you just need to look out is two parallel zones where prices just stick in between them. So in between these two zones, prices are ranging, and that's what you're looking for. You're looking for price to be ranging between two zones. It won't always be perfect, but you can usually tell price is actually parallel here, and you get your move to downsides between this range. You get your move to the upside between these range, and you just see prices stuck. Price is effectively stuck. So anything that happens in between, in the middle of this, you just have to kind of disregard it and wait for it to play out. until you get to the top here. This is where you get your interest. Here, you have your first push to the upside, trying to entice people to get involved in the trade nice and early. Don't fall for that if that happens. You wait, you get your push up again, and then you get your big bearish engulfing candle, your pullback there onto the line here, and that's where you'd like to enter. If you miss that, you've always got your opportunity when it breaks out. You get your first chance on the pullback here, second chance on the pullback here, and even in this case, you get a third chance on the pullback here, but you don't always get that. So you can see price stuck here, ranging, breaks out, taps that. This is almost like a fake out here as well. And then you get your push down, 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 down. So how do you draw one of these? Let me show you real quick. This is an example I did earlier just for you. So I'll talk you through that. So first you see prices coming down, and then you see these two parallel levels here, one there. So we just refine that, and you get your drawing tool, and you see the bottom. And sometimes you have to disregard the wicks with these because you do get little fake outs. Don't let them put you off at all. So you have price come down, price is stuck, and it's ranging between this up, down, up, down, up, down, never really breaking or showing any intention to break. And then you get your big bearish engulfing candle there, and price just goes down from there. So onto our final candle formation, which is the wedge. So with the wedge, it's just like a flag and triangle as they occur during a bull or bear run. They come trying to make a pullback before making another push in the initial direction. And just like in a triangle, price is condensing, it's compressed in preparation of the bigger move. So here, falling wedge is bullish, so you have your price coming up, trapped in the wedge, up, down, up, down, up, down, and then pushes up from there. And with the rising wedge, price is bearish, trapped between the wedge, and then you push down from there. And that's how you trade it. So let me show you some examples. So with the wedge formation, well, one thing you need to notice is price is always going to continue in that direction. But with your two lines that you draw, they have to be in the same direction. So unlike a triangle, which the price can be coming from different directions and compressing, you can have one bullish and one bearish line. With this one, they both have to be bearish in a bearish or falling wedge. So why? It's because this is stronger than this one, and it's pushing price down onto this one, which is also bearish. And eventually price just goes up and up. So what happens here? You get your push up, you get your push down, you get your push up. This is almost horizontal, but still bearish trend line. And you get price just stuck in between these two levels. And then it's condensing at the nose a little bit. And then you get your push out, your breakout, your little pullback for your entry here. And then price goes up, up, and up. And onto a rising wedge. You see price is initially higher and coming down, all in, comes up, and it's trapped in these levels again. Like I said, these two lines are both upwards, but one's steeper than the other. The one beneath is steeper than the one above, and it's just getting a trap. You get your bearish engulfing candle here, and you get an even bigger bearish engulfing candle here, just to show the intent, and you get a nice move to the downside here, just like that. So how do you draw one? Well, I prepared that for you earlier, so I'll show you that now. So here you have price coming up, so this is going to be a falling wedge, and you get your top point there, you get your drawing tool, you see this almost slightly downwards sloping line, you get a few touches of that, 1, 2, 3, just refine it a little bit here, and what you get is price up, down, up, down, up, down, and it's just condensing at the nose. It pulls back, so that's your opportunity for entry that I'm highlighting now. And you see price from there just goes up. So that's how you trade the wedge candle formation. And yeah, so just to conclude, trading with price action should always be accompanied by technical analysis. So you shouldn't purely trade off price action. You want to put technicals in there to help. And that's because it gives you the best results and it makes a high probability trade, which is what we're looking for. So once you combine these confluences just means a reason for a trade, you'll see how powerful and how effective they can actually be. And I'm just going to quickly show you an example of two that I traded off. So here you have, if anyone's noticed already, the inverse head and shoulders, price coming down, makes the neckline, comes down to make the head, back to the neckline, similar level on the right shoulder, and a push up. So let's take an even closer look on this, shall we? So on the left shoulder, if you can see here, you actually get a tweezer bottoms as part of an evening star, a morning star, which sees price push up. You get price push up, and then here you get tweezer tops as part as an evening star, which sees price comes down. You get tweezer tops here again, price coming down, another evening star, price comes down. So that's a load of confluences there in terms of price action. And then price comes down, creates a head. And then when price comes back up, you get your initial, not quite tweezer tops, not quite clean, but you get your almost evening star here, and you get your push down. And at this level, you get morning star here and morning star here, and they're both sitting on the support level, and you see them all come together, and together they just go up, up, and up. So my entry would have been around here, but just in case you missed it, I can show you this one here. Gave an opportunity to enter the trade quite nicely as this level is holding, and you see all the price action coming together with your technical analysis, just basic technical analysis, your chart pattern, your support level, and your price action all coming together to make a nice profitable trade here. And let me show you another one. So here is a flag pattern. So we've already gone over this today. At the top of this, or before that actually, you see price coming up. So that's your first confluence that price is going to continue coming up. You get your double top here. So you have your rejection level here. Price moves down, comes back, rejects off that again. And then price gets trapped in this zone here and in this zone here. So you get price stuck up, down, 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 up, down. A little bit of a fake out here. And then you get a strong bullish run. Price breaks above. And then you get your pullback opportunity here. So this is where you'd enter around here. And you see price push up and up and up. And this one must have been about 6-to-1 risk reward ratio. So it's quite a nice trade to take. And you'd be exiting around here because price action is suggesting you get your big wick to the upside, you get your evening star, and price starts to come down from there. And that's how simple it really is to use these with your technicals to get a nice trade opportunity. So like I said, there would be a little cheat sheet at the end, and here you have all of the candlestick patterns, even the ones that we didn't go over, and the ones here are bullish, so they signify that price is going to be going up. These are neutral, so they signify that price is slowing down, and these are bearish, so they signify that price is going to be coming down. So that's how you use them. And yeah, so if you need them, take a screenshot now, and I'll go into what's to come in chapter 3. So in chapter 3, I know you've heard me talk about trend lines, support and resistance levels today. That's going to be covered in the next chapter in depth. and key levels, and you're going to learn how to identify these as well as utilizing them with what you've learned in this chapter to create the start of your own trading plan. So I hope you enjoyed, and I hope this has been very educational for you, and I hope to see you in chapter 3. Thanks for watching. Bye.